Most Canadians don't realize this, but the wealthiest families aren't passing down stocks, real estate, or cash. They're passing down a tax-efficient structure. And one of the most effective is the estate bond strategy. My name is Laurent Munier. I'm a partner. I'm an advisor here at Safe Pacific Financial. And if you're an incorporated professional or you're an entrepreneur or a high-income Canadian, the biggest threat to your wealth isn't market volatility. It's taxes, especially at death, and poor estate planning that can quickly take half of everything you've built. So that's why today, I'm breaking down one of the most reliable tools for creating long-term security and a predictable wealth transfer. So it is a whole life policy combined with an estate bond strategy. So let's talk about how to convert these taxable dollars into a structured, tax-efficient legacy for your family. So what is an estate bond strategy? So the really simple, why would you do this? What's the benefit is you've got excess savings, either personally or in your corporation, that you're probably not going to use while you're alive. Now, most of our clients have this money earmarked to pass on to their kids or to their grandkids in the future. But if you just pass on this money to your kids when you die, there's going to be a lot of tax due. So this simple strategy that uses these excess savings to fund a permanent life insurance policy that's going to pay out tax-free. So you save a ton of money in taxes so that your kids and your estate receive more. Now, to make it work, you're going to get a participating whole life insurance policy with a strong Canadian life insurance company that will provide lifetime coverage. It'll provide guaranteed cash value growth, and it'll give you the opportunity to earn dividends from the insurance company's participating account. This type of insurance is also called PAR insurance. So the PAR is short for participate. So this indicates that your policy participates in the insurer's profits, which means that you can receive a dividend on top of the guaranteed growth. This creates a conservative and stable and long-term financial asset. And then because these PAR policies combine this predictable growth, they have the tax-efficient accumulation inside and the permanent death benefit, the tax-free death benefit. They are very ideal for advanced estate planning. And this is where the estate bond strategy comes in. So the estate bond strategy uses one of these participating policies as a structured vehicle inside your estate plan to do a few things. So number one, it accumulates tax advantage cash over your lifetime, which compounds safely without the volatility of the market. Secondly, it delivers a large tax-free death benefit to your beneficiaries or to your estate or to your corporation, which creates immediate liquidity when it's needed most. And number three, it really reduces your taxes at death by replacing these taxable assets with a tax-exempt insurance payout. Four, it bypasses probate delays, it bypasses administrative costs, and it ensures that your wealth passes quickly and privately to the next generation. And it also leverages the capital dividend account, or your CDA. So this is only if the policy is inside your corporation, usually a holding company. So this allows proceeds from the death benefit payout to flow tax-free from the corporation to your heirs. And the way that that works is death benefit pays out to the corporation, you subtract the adjusted cost base, and that amount there becomes your capital dividend account or your CDA, which can flow to the beneficiary shareholders of the corporation in a tax-free way. So in short, a properly designed participating policy can do a few things. So it provides the long-term tax-efficient growth that's really unmatched by any sort of traditional fixed income or low-yield investments, especially things that have guarantees on them. It supports liquidity for your estate. So it can do things like cover your capital gains taxes. It can cover debts, outstanding debts. It can fund a buy-sell agreement in the corporation. Or it can really just ease the transition of a family business without having to force the sale of other things like real estate or stocks or corporate assets. It also allows you, in a corporate way, to move your retained earnings from the corporation into a protected, tax-efficient structure. And so this gives incorporated professionals and business owners a strategic way to convert taxable corporate dollars into tax-free generational wealth in this rather simple strategy. So in short, the participating whole life policy added to the estate bond strategy is a really conservative, and very highly effective method for Canadians who want to protect their estate, they want to minimize their taxes, and they want to leave a predictable legacy to the next generation while still maintaining control and flexibility during their lifetime. Here is how this participating account plus the estate bond strategy works. And I'll give you just like a step-by-step. So number one, you got to set up the insurance, right? So you set up the whole life insurance policy and you want to set it up as early as possible. You want to be as young as possible when you do this. And the strategy really begins when you set up the policy, right? You set up this whole life insurance policy. And again, like I said, ideally it's as early as possible so that you can have the most amount of time for long-term compounding of that dividend. So as the dividend pays, you want to receive as many of those as possible, right? So you want to set these things up when you're young and you want to die as old as possible so that you can compound as much as possible. And then the growth inside with this dividend is very efficient because the life insurance policy is tax exempt. You can own the policy a couple of different ways. You can own it personally, or you can own it through your corporation or a holding company. You can also own it in a trust. If you're doing it in a holding company, you can take advantage of corporate tax rates. And you can also take advantage of when the life insurance pays out, it creates this capital dividend account, which you'll see tons about it. We talk a lot about it on the videos on our channel. Number two, the second thing you want to do is you need to fund the policy with your premiums and you need to build up this cash value, right? You need to build up the cash value over time. So what you're going to do is you're going to fund the premiums with these excess savings or the retained earnings that we were talking about. So this is the money that you know you're not going to need during your lifetime. And you've probably got it earmarked for your kids or your grandkids or maybe to a charity or a school or a church or whoever you want to give your money to when you pass away. And then when you make your annual premium payments, some of the money goes towards the life insurance and some of the money goes towards your policy cash values, which then will grow with the dividend. And then the dividend will also make the insurance grow too. So this means that your money is increasing through a couple of different things. So number one, you've got the guaranteed cash value growth that's in the contract of the insurance. You've got the annual dividends from the insurance company's participating account. You've got the long-term compounding that is not affected by market volatility. So regardless if the stock market is going up or down, these insurance policy, the participating account in the insurance policy is not correlated to the stock market. So it doesn't go up and down with the stock market. Plus it comes with a lot of guarantees that the money will never go down. And the specific word for this is that the money, once it hits the account, once it hits your cash values, it's immediately vested, which means it's guaranteed at that floor and it'll never go down unless you take it out. But the participating account value is not going to go down. So over time, this PAR account becomes really a stable, conservative asset class inside either your personal structure or your corporate structure or your trust structure, however you have that done, or however we help you set it up. Thirdly, and this is really important, especially when you're doing this, you want to work with somebody who knows what they're doing as far as the policy ownership structure, as far as how you set up your beneficiaries, as far as how do you actually set up your organizational structure, whether it's personal or corporate or trust. A really key part of this estate bond strategy is the structure. So again, I'm going to say, you need to work with a good team when you do this. You don't really want to work with somebody who's never done this before. Some things that you're going to consider. Number one is who owns the policy? Is it you personally? Is it your holding company? Is it your trust? So where do we own the policy? Secondly, you want to have your beneficiary designations set up correctly. So depending on how you own the policy, those beneficiary designations need to be set up in the correct way. Another thing that you also need is if you're setting this up in a company, you need your shareholders' agreement for the company and it needs to be written correctly. And then this is where we can help give you some verbiage and some guidance to talk to your lawyer when you're writing the shareholders' agreement. You also want to consider your family trust, or maybe there's a corporate reorganization plans, right? So maybe your corporation, who owns the corporation? Are you owning it personally, or do you have a family trust to own that holding company? So by considering these things, this ensures that that policy works seamlessly with your estate plan. It also needs to work with your business structure, and it needs to work with your wealth objectives for your family, right? Your intergenerational wealth objectives. Now, if you're incorporated, the corporate ownership of the policy can open the door to tax-free distribution at the end through the capital dividend account. That's an important thing to know. A fourth thing that you really want to think about is you want to access the cash value strategically if and when you need it while you're alive. So the primary goal of this estate bond is the estate maximization, right? Getting the most amount of money to the next generation. But your participating policy's cash value can be accessed during your lifetime for all sorts of reasons, right? You can use it for business continuity. You can use it for unexpected expenses. You can use it for market downturns. You can use it for opportunity capital. So we call that our bullet fund. So if you're ready to take a shot, you need a bullet. And so having the cash inside these policies is a really good place to store money that you can now execute on something. So whether that's investments or expansions or real estate or buying something. Another good thing that you can use this money for is emergency liquidity. So for whatever reason. And then you can also use it in retirement planning or supplementing your income during retirement years. So unlike traditional investments, accessing the cash value doesn't require selling assets. It doesn't require you to trigger capital gains. It doesn't expose your wealth to market risk. So now if you've watched our videos before, you know that for our clients, we generally access the cash values through collateral lending with a bank or through policy loans from the insurance company. So you keep the money in the policy, and then when you need it, you create new money through loans, which then you spend or invest. Number 5 is the big value for the estate bond strategy is the tax-efficient wealth transfer at death, right? So when the insured person passes away, probably that's you, the policy will pay a tax-free death benefit, depending on how we've set up the beneficiaries, depending on how you've set up the ownership, but it'll usually either pay directly to the beneficiaries, or it'll pay to your estate, or it'll pay to your holding company, or it'll pay to the trust. And this really depends on how we set it up, right? None of these are right, none of these are wrong. It's just the way that we set it up. Now, if the policy is owned in your corporation, most of the death benefit will credit towards the capital dividend account. So you'll have your death benefit minus the adjusted cost base will go to the capital dividend account. And if you've had the policy for a long time, your adjusted cost base is going to get closer and closer to zero the longer you own the policy. So probably most or all of that death benefit is going to pass on tax-free and create the capital dividend account. The funds then can be distributed to your heirs, to the company shareholder beneficiaries in a tax-free way, which will bypass your traditional estate erosion, right? It's going to bypass the giant Ottawa tax scoop that just says, thank you, we will spend this money because we know better than you do. What does this do? It provides immediate liquidity to your estate without forcing a sale of other things like real estate or stocks or even the family business, buildings. There's all sorts of things that families have built up over time that they want to keep going to the next generation, but you do need to pay a bunch of taxes when you die. It's called a deemed disposition on death in Canada. We don't have specifically an estate tax like they do in the US. The function is the same of the deemed disposition. You're still getting a giant tax on death. Number 6, this creates a seamless business succession, and it also creates estate liquidity. So the death benefit from the life insurance can be used for whatever you want. Well, actually not you, you're not going to be here, but for whatever they want. But these are some kind of common things that people would use the funds for. So one of the biggest ones is to cover capital gains taxes due at death. So like I was saying, you have a deemed disposition when you die, which means that the CRA, the Canadian government, the Canadian taxman, assumes that on the day you died, you sold all your assets, and then whatever taxes is due on that is due now. It's due this year. So that includes your business, that includes your portfolios, that includes your real estate, that includes anything that you own that could be taxable. The CRA wants it when you die. Another thing that it's used for is to pay off corporate or personal obligations or debts, right? So if the corporation has debts, the life insurance can pay out and you can use that life insurance money to pay off debt. Or if your family has debts or you have debts or your state has debts, they can be paid off using this life insurance money. Another thing too is equalizing inheritance. In Canada, you're supposed to make your inheritances equal among the beneficiaries, right? So this is into the wills and estates rules. Sometimes it's tough to do things equally. So maybe there's a business and some of your kids or one of your kids is operating the business and is going to receive the business and keep it going. But then your other kids are not involved in the business and they're not really going to receive the business because they're not involved in it. So maybe this child is receiving the business, but then what do these guys get or these girls get? So a good way to equalize the ones that are not receiving the business is by giving them money from the insurance, right? So you get the $1 million business, you get $1 million cash, however you want to equalize that. Another thing that you can do too is, again, if you're doing this corporately, is you can fund your buy and sell agreement for succession. So if you've got a partnership or multiple people that own the business and one of them dies, well, generally their shares are going to transfer to their spouse. This is generally the way that this kind of estate succession works. Do these other partners want to be in business with your spouse? Probably not. So what you can do is use the insurance money to pay out the spouse and rebuy the shares. So then the remaining partner or partners would then keep the business and then your spouse gets money instead of the business. And then this is another big one. It prevents the liquidation of these hard-earned assets. So maybe over time, you've had a successful life and a successful career, and you've built up some assets that you would like to pass on to the next generation, right? So maybe this is buildings or homes or a portfolio or another business or whatever it is. You don't want to have to sell those to pay taxes on something else. So again, by having this life insurance payout, you have cash. And then when you owe taxes on whatever this thing is, you just use the insurance money to pay the CRA and say, I'm keeping the building. Here's your cash, Mr. CRA. So really, what does this do? It ensures that your business, that your estate, that your family transition, and that the wealth transition is smooth, it's tax efficient, and it doesn't put excess financial pressure on all these other people. Especially, like, you got to think of, when is this happening? All of this happens when you or whoever the insured person is passes away. So that's a traumatic event. It's a traumatic period in people's lives where having this money helps to relieve a lot of pressure. Like, there's a lot of things going on when somebody dies, and you don't want money to cause another stress. So having this life insurance payout quickly can relieve a lot of stress. Obviously, it's not going to bring you back. It's not going to fix emotional damage and things like that, but it can pay for taxes. It could even just pay the mortgage. It can pay your hydro bill. It can pay all sorts of different things, whatever the cash wants to do. So now, why does this estate bond strategy matter for high-income Canadians, for incorporated Canadians, and for families that have assets, right? If you are a high-income Canadian, and especially if you're incorporated, if you're a professional, you're a business owner, or you're a family that just has assets that are growing, this participating whole life policy coupled with the estate bond strategy offers a really predictable, tax efficient, controllable wealth transfer that's unlike any other types of structures available in Canada, right? Like, there's not a lot of ways that you can do this. And unlike traditional investments that would create what's called a tax drag, or estate assets that might not be liquid or that might be tied up in probate for years, this strategy builds a financial foundation that really supports your lifetime goals and then passes cleanly to the next generation. It's tax efficient, it's predictable, it's long-term growth, right? The participating whole life insurance that we're using, it provides these guaranteed cash value growth, which also gets supplemented by dividends from the insurance company's participating account. And then because the growth inside the policy is tax deferred until you take it out, you compound this wealth more efficiently than you would in another type of taxable investment or in another corporate passive portfolio or something like that. If you're a high income individual and you're in the top marginal tax rates, right? Like, it can be over 50% depending on your province. This significantly increases your long-term net gain while also reducing your exposure to investment volatility. It also provides essential estate liquidity when your family needs it the most, right? So many successful Canadians have substantial net worth, but most of that wealth is tied up in non-liquid assets. So either corporation, real estate, investment properties, private investments. So at death, the CRA is going to deem these assets sold, which could trigger a large capital gain and tax liabilities. So instead of having to sell other assets under pressure and in speed, like you got to do it right now, This estate bond strategy provides instant tax-free liquidity to cover estate taxes, to equalize the inheritance, like we talked about, to fund a buy-sell agreement, or to just protect the continuity of the family business, right? So some cash on death helps smooth a lot of things, right? It helps to grease a lot of things. This prevents fire sales. It protects the value that you've spent years and probably decades building. Another big advantage is that you have full control and you have full flexibility during your lifetime. So one of the biggest advantages of this strategy is this control. So you stay in control of the policy ownership, you stay in control of the policy structure, you stay in control of how the cash value is used, you stay in control of how the strategy integrates with your corporate planning, you stay in control of how and when the wealth passes to your heirs. With the death benefit payout, you could even have what they call control beyond the grave. So you can have the death benefit payout, they call it an annuity payout option. So you could say, okay, call it a $2 million death benefit payout. You could say, have an annuity settlement option that's going to pay this out every month for the next 10 years, or every month until this other person dies, or every year, however you want to do it. Because, not everyone's kids come out the best, right? So some kids maybe have issues with drugs and alcohol, or spending, or gambling, or maybe they have friends that take advantage of them. So maybe you don't want to give your kid $1 million in one shot, but you do want to make sure they're taken care of. So you could give them a certain amount every month or a certain amount every year. And we've literally had this where a client told us, like, listen, we cannot give this adult child, like in his late 30s, cannot give him the money because the adult child had a massive drug problem. The mother said that if we give this guy the money, he's going to kill himself. He's going to die probably pretty quick, because all of that money is going to go straight in the veins. So you can set it up to pay out over however you want in what's called an annuity settlement option. And then because these types of policies are private, and because they're a contract-based asset, it gives you this clarity and predictability. It gives you freedom to adapt the plan as your needs evolve. And again, you don't have to rely on the stock market, and you don't have to rely on government program rules, right? So you don't have other people telling you how and when to spend your money and how much to take out and whatever. This is all under your control, and it's private. Another big advantage is the avoiding probate and to reduce your estate erosion. So when you properly structure this estate bond strategy, and when you properly structure your life insurance proceeds, the life insurance death benefit can bypass probate. It can get the money quickly to who you want it to. It can get it there privately, and it can get it there efficiently to whoever the beneficiaries are that you state. Why is this important? It avoids delays. It avoids public disclosure of your assets. So a lot of people don't necessarily want the whole world to know who they're passing stuff on to and what did they have, right? So any assets that are passing through the will, when you pass away, your will goes to court, which is the probate process, and then it becomes a court document, so it's public. So anybody can go to the courthouse and look at your will. Not the next day, but like within a couple of weeks as it gets processed, you can go look at anybody's will and see how much do they have and who do they give it to. If there's a dispute and it goes to court after that, then even more details come out. It's actually kind of crazy how much you can learn about somebody's family by just reading court documents about their estate. There's also probate fees, right? So having the life insurance payout and not go through probate saves you, again, depending on the province that you live in. Some provinces have lower and some provinces have higher probate fees, but they can really add up. And really, it creates a smooth estate transition. So the money goes from here to the next generation smoothly, quickly, privately, tax-free, right? All things that you want. So this is really ideal for people who are incorporated. You've got a business, maybe you're an incorporated professional. We have a lot of incorporated lawyers, a lot of incorporated engineers, a lot of incorporated accountants. So maybe you're a partner at a law firm and you're operating through a law corp, or you're a partner at an accounting firm and you're operating through your own corporation. This is a good way to park your retained earnings, right? So if you're a business owner and you've got these retained earnings inside either your operating company or holding company, generally, hopefully holding company, this estate bond strategy is a powerful way to convert this taxable corporate money into tax-free estate dollars. It also allows you to use the capital dividend account to distribute these proceeds tax-free to the company's shareholder beneficiaries. And it allows you to build a long-term guaranteed asset that supports both your corporate and your personal wealth goals, right? So instead of letting this corporate cash sit in a passive investment that's subject to really high tax rate, the participating account provides this stable, tax-efficient alternative that's aligned with your estate and your succession planning goals, right? So now I've talked about really a lot of the good about it, but we'll talk about the benefits, also some cautions, because you definitely need to know about the cautions. So the benefit is that it guarantees the legacy that you want to pass on to your kids or to your grandkids, right? Because the permanent life insurance contract guarantees that that money is going to get to your beneficiaries in the smoothest, quickest, most tax-efficient way. It gives you the long-term predictability. It gives you the tax-efficient accumulation. Because of these participating accounts, they grow steadily. They're not affected by market volatility, and they have the tax-deferred compounding inside the policy, which is really ideal for long-term estate planning. And it'll help to support your business succession plans and your legacy plans. So when you do this estate bond strategy, the policy provides the liquidity to fund a buy and sell agreement, or to equalize the estate among children, or to keep the business running. The company can use the money to go and find somebody to replace you. Hopefully you've done your succession planning in advance, but if you haven't, this is a way to at least provide some money there if you're not there. It also protects your asset value and ensures this continuity, right? The death benefit prevents a forced sale of real estate or corporations or other investments or other assets. It preserves the legacy that you built, and it prevents unnecessary tax erosion. So it prevents Ottawa from taking 50% off the top and saying, we know better how to spend your money than you do. It also provides efficient intergenerational wealth transfer. So with the CDA integration, if it's inside a corporation, your heirs would receive a tax-free distribution, which dramatically improves the estate outcomes compared to passing them a taxable investment transfer, right? Obviously, receiving money tax-free is, most people would rather have that than receiving money and then it's taxed. So now let's get into the cautions, the considerations, right? Everything is not just sunshine and unicorns. There are some things that you do need to consider. Number one is the complexity. You need to have an expert to help to structure this for you. So the participating whole life policies, the estate bond strategy needs to be set up and designed correctly. Not setting it up correctly and having a poor structure can really limit your growth. It can mess up the tax advantages, or it could misalign your estate goals. And so you do need to work with somebody to set up the insurance properly, and you need to work with a proper wills and estates lawyer to set up your will, to set up if there's a trust or if there's a holding company. And how are you going to set up this organizational structure? You need somebody who knows what they're doing. Not all insurance advisors are going to be able to set this thing up properly. This is where we come in. Not all lawyers are going to be able to set up your estate properly, right? It's not the kind of situation where you're like, oh, my cousin's a lawyer, they'll do it for me. And you're like, your cousin is a personal injury lawyer, not an estate lawyer, right? You need an estate lawyer to do this. You don't go to just any lawyer because they're a lawyer. There's all sorts of different lawyers out there. Another thing that you definitely need to consider is the premium commitments need to be maintained, right? So you don't want to lapse these policies. You don't want these policies to cancel because you didn't pay it. So if the premiums lapse, all of these guarantees are compromised, right? So if you're paying these premiums, you need to ensure that it's affordable in the long term and that you can consistently put the money in. Again, this is why I said right at the very beginning that you're probably going to be using excess cash that you're not going to use during your lifetime. So whether that's personally or inside the corporation, and then we know, okay, well, this is money that you already have. It's already allocated. We can then put it into an insurance policy to get all of these other advantages. Another thing that you need to consider is that you need to coordinate with professionals, right? So to maximize the benefits, especially to maximize how you use the CDA, the corporate structure or the trust structure, you need it to be aligned among your advisor, hopefully us, your accountant, and your estate lawyer. All of these professionals need to be on the same page and need to be working together to set this thing up properly. And without the proper coordination, you could lose the tax efficiency, you could create unnecessary complications, you could end up paying a ton of fees because if you set it up one way and it's wrong and then you need to set it up another way, This could be thousands of dollars in legal fees just to like restructure stuff. What's our approach, right? We are integrated, we're tax smart, and we're built for this generational wealth. This is kind of like what we do all day. So we set up the whole life insurance policy, but it doesn't just stop there, right? We build this fully coordinated estate bond strategy that will align with your corporate structure, that aligns with your tax planning, that aligns with your long-term family goals, your generational wealth goals, right? Our role in this is to ensure that every part of the strategy works together seamlessly, so you get the efficiency, you get the strong long-term performance, and you get the predictable legacy for the next generation the way you want it. What do? We set up a comprehensive review of your corporate and your personal financial structure, right? So we begin, number one, by analyzing your financial picture. We want to know about your operating company, your holding company. We want to know about the retained earnings you've got inside. We need to know your estate goals. We need to know your income structure, like how do you pay yourself? We need to know your tax situation. And we need to know if you have an existing wealth plan that we need to work with, right? This helps us to determine the most effective way to structure the policy so that it can deliver the maximum tax advantage growth, and also so that it can set up the estate according to your goals, right? Then we'll set up the insurance and we'll coordinate with the rest of your team, your other advisory team. So this estate bond strategy requires proper structuring. So we work with your lawyer, we work with your accountant, we work with any tax specialists that you may have. Maybe it's cross-border. There's people that, a lot of USA, Canada, a lot of China, Canada, a lot of Hong Kong, Canada. We want to set up the correct policy ownership. So who owns the policy? Is it you personally? Is it your corporation? Is it your trust? We want to set up the correct beneficiary designations. And these have to be correct, because if you don't have them set up properly, it could ruin the whole plan. We want to set up the correct shareholder succession or integration, right? If your company is passing to somebody, that needs to be done in a certain way. And we also want to make sure that your trust or your holding company is set up correctly and that everything's aligned, that all of these things are going towards the same goals. And what does that do? It ensures that this policy fits into your estate plan, into your tax plan, into your corporate framework, and not just right now, but we need to set this up so it works next year and in 10 years and in 20 years, right? Decades into the future, because probably you're not going to set up an insurance policy today and die tomorrow. That's probably not going to happen. So we need to set it up today so that it works one day in the future, because there's not two chances to get it right. So if you don't have a great accountant, if you don't have a great estate lawyer, if you don't have a great tax specialist, well, part of our added value is introducing you to our trusted network. So we have a lot of professionals who can help to build out this strategy, especially this estate bond strategy. It's a little bit complex when you've never heard of it, but it's not that complex when you do it every day, right? So we work with the correct lawyers, the correct accountants, the correct tax planners, us, where this is not super complex for what we're doing. But if you've never heard of it, it does sound complex. And then over time, right, this is going to be a policy that you have for some time. There's going to need to be ongoing monitoring. There's going to need to be ongoing policy management, because things are going to change over time, right? And it's super important. And this is where you could go wrong by not working with a great and reputable advisor to set up the insurance. The strategy does require ongoing maintenance over time, and whoever you work with needs to do work every year to make it happen. So as part of our service, we track the cash value growth, we track the dividend performance, we get all the policy values to your other advisors annually or when they need it. Or if it's corporately, maybe it's on a year end. We monitor your premiums. We make sure they're paid. We make sure policy loans are set up correctly or paid. We make sure there's repayment schedules that fit with either the insurance company's requirements or the bank's requirements. We can adjust ownership. We can adjust beneficiaries. If your business or family structure changes, we might need to make changes. And we want to make sure that we ensure that the policy stays compliant. We want to make sure it stays tax efficient. We want to make sure that it stays aligned with your goals. And we're proactive about this. We have a proactive approach that keeps your strategy working smoothly, even as your life changes and evolves, right? So we want to set it up today for the long term, but there's also flexibility as we go along. And then there's full integration with your long-term wealth strategy. So this whole life policy then becomes one pillar of a much larger plan. So we're going to integrate this with your investment management. So, we can help to invest the money for you with our partnership with Harness. So we've got a fiduciary-backed platform that we use for investment management. With your risk mitigation planning, with your corporate retirement strategy, so are you going to be using the corporate money to retire? With your estate equalization, so maybe some of your kids are inheriting some of the estate and some of the kids are inheriting money. So how do we do that? And then the generational and intergenerational wealth planning transfer. So is this passing to your kids, to your grandkids, to their kids, to their kids? We don't know. And we will figure this out. We want to create a holistic, tax-optimized estate plan that protects your capital, that builds the wealth, that does this all predictably, and transfers it efficiently through, if it's corporate, the capital dividend account. I encourage you to watch the many videos about CDA that are on our channel. You can click on the screen somewhere, or it's in the description. And this video is getting really long, so let's wrap it up, Laurent. The call to action right now is that your legacy deserves more than just good enough planning, right? You need more than a will if you are high income, if you're incorporated, if you've got a trust structure. If you're a high income Canadian, if you're a professional, if you own a business, the greatest threat to your long-term wealth is not the market volatility going up and down. It's not a bad investment. It's not a bad year. It's poor planning, it's avoidable taxes, it's the lack of liquidity when your estate needs it most. These are big, big risks. And if you want to protect what you've built, if you want to make sure that your family is taken care of, if you want to make sure that you transfer the wealth efficiently, this estate bond strategy is one of the most effective tools available in Canada today. It's pretty simple and we can do it for you. It provides predictable, tax-efficient growth. It provides a large tax-free payout to your heirs, to the people that you want. It provides liquidity when the estate needs it the most. And it provides a clean and efficient wealth transfer without having to sell off other assets in order to pay taxes or in order to equalize the estate. So it's not just about insurance. It's about creating a fully structured estate plan that actually works when life happens and when the worst things happen. A properly designed estate bond strategy, really what it does is it converts these taxable corporate dollars or personal dollars into a tax-free generational wealth transfer. It avoids probate delays. It avoids CRA surprises. It keeps your business or your real estate or your investments in the family if that's what you want. And it ensures that your estate has the cash it needs without having to sell other assets under pressure at the worst time, so that you can leave behind a legacy that's organized and predictable and tax efficient and clean, right? You don't want to be leaving a mess behind. And so this is exactly what we specialize in. We will map out your tax profile, your corporate structure, your family goals, your long-term vision, and then we can build a strategy that integrates seamlessly. And we work together with your other partners, your accountant, your lawyer, any existing planning you have. Maybe you're a partner in a corporation, so we want to talk to that person as well, right? So for many of our clients, this becomes one of the most powerful estate planning tools that they've ever implemented, right? And if you're really serious about protecting your wealth, about protecting and building a tax-efficient legacy, the next step is really simple, is set up a meeting with us. You can book a consultation to us today, and we can talk about if this estate bond strategy is the right fit for your situation, and what does it mean for your family over the next 10, 20, 40, 50 years. How do you book a time? Super easy. Click on our website, safepacific.com. There's a bunch of buttons on the website where you can schedule straight into our calendar. You can also hit the contact page, and through there you can send us a message. That'll come straight to me. Somebody will get back to you within 24 hours on business days to set up a time to meet. It's really, really simple. Just click one of those buttons and book in our calendar. Now, before you go, if this video gave you clarity, if it sparked ideas, if this is something that you feel like it was really important, click on the like button, click on the subscribe button, share it with other Canadian business owners or professionals who maybe don't know about how this all works or who want access to smarter strategies. Any of these likes, shares, comments, subscribes, they really help the algorithm to find other people like you, because successful Canadians that have an estate that they want to transfer to the next generation, sounds like everybody should do this, but really it is a minority of people. So leveraging these algorithms to try to find more of these people is actually really important. So that's it for today. This video is a little long. I hope it was valuable for you. Thank you for watching. My name is still Laurent Munier, and I will still see you next time.